So you got a distressed property, you want to go in there and fix it up. You don't want to use your cash, or you might not have the cash. You go find a hard money lender that will come. If you're a first-time investor, they're going to come make sure, look at the property, look at the numbers, make sure they make sense. For your more experienced investors, once the hard money lender sees that you've been doing multiple properties and you got the hang of it, they'll just sign off on it.
Came here in 2007, right in the middle of the crazy crisis. If your heart is not into it, do not do it. That's what I always tell them.
If you're making around $70K, look to be able to qualify for a home somewhere around $250, $275 in that bracket.
Onions and juices and all that, and put some lemon and onion and you make him drink it, right?
And Alex, all my listings need a video. All of them.
Hey guys, welcome back to Let's Keep It Real Now. I am Danielle Bilumbu, your favorite host, and I'm here with
Abu Jabi with A&P London. How y'all doing?
Mm-hmm. And then we have a special guest over here. She decided to stay with us. Yes. It's Fatmata. And then because I know you will want to know all this information.
Yes, ma'am, I do.
Yes. So the goal today is to talk about how some people, unfortunately, if you do not have a W-2, and sometimes it gets very, very challenging for you to qualify for a loan, right? Because, when you're working, you have a business or you have a side gig or whatever gig you're doing on the side, right? Mm-hmm. You don't want to pay a lot of taxes. So we tend to put a lot of expense into our taxes and to show that we don't have that much revenue or income. But then it's going to come and bite you in the behind.
Yeah.
When it's time for you to buy a house or any type of property investment and so on. Sure. So today we're going to dive into the alternative way of financing outside of the regular traditional way that everybody know, FHA, conventional, and so on. Mm-hmm. So this is for all my self-employed, gig worker, someone without a W-2, and they need to secure a 30-year mortgage to purchase a property investment or for themselves. Mm-hmm. Okay, so let's dive in today, and thank you for being here once again. Hey, Abu. Hey. So tell me. So the first one I want to start is I hear this one a lot, and you did help a lot of my client with that one, is the non-qualified or non-QM loan. Yeah. So could you explain what this is exactly?
Yeah, so basically what non-qualifying mortgages is a loan that doesn't qualify with Freddie or Fannie, right? Mm-hmm. So we have Freddie or Fannie that is under the umbrella of the FHA and the conventional loans. So what they did was you had different investors that were able to come up with this product, which is a non-QM loan. So with that, it's not going to be regulated the same as with Fannie and Freddie. So you're going to be able to have options where you have bank statement programs, right, where we're not going to look at paycheck stubs. We're going to look at how many, if you have a business, how much
in revenue.
Yeah, deposits that you're making monthly on those bank statements. So we might ask for 12-month bank statements or 24-month bank statements to be able to qualify to get an average of those deposits to be able to use that for income. So that's one example of a non-QM loan.
Do you have to, when you do that, the 1-year bank statement, mm-hmm. Do you present also your expense? Do you guys ask for profit and loss, or you just look at the revenue?
So it depends on the business, right? And it depends on the underwriter. Sometimes they ask for P&L statements for the current fiscal year from beginning of the year to whenever we're doing the loan. Mm-hmm. And then sometimes they don't ask for it. Sometimes we might just ask for 12 months, and then as far as the actual expense itself that the business has, typically they'll do 50% expense up front, right? But if you have a CPA that does your books, that does your taxes, as long as they can write a letter stating that your expenses, let's say 10% or 20%, we can use that as a factor versus using the 50% to deduct the income.
But the CPA is usually the one doing all of that to make sure you have a lot of expense on your stuff. Mm-hmm. But he needs to write a letter that we overdo it.
Exactly.
Okay.
If you have a CPA that would be willing to be able to state that, hey, this client only has a 10% expense with their business based on the income that they have, we'll just give you a 10% deduction or 20%, but the max is 50%.
So, but usually the underwriter go with the average of 50%. So if you brought in that
50%.
year 200,000, is gonna say 100,000 worth of
100,000,
expense.
but that's only for business bank statements.
Oh,
Right. So if you're providing me business bank statements, because the way that it works is, you're going to pay the business first before you pay yourself.
correct.
Right. So you're going to have your business bank statements. They're going to have everything that the business is bringing in. If you bring me your personal bank statements, where you're transferring it from business to your personal, it's only a 10% expense.
Oh, so it's better for me to give you my personal.
It's better to give the personal, but a lot of people just work with their business. So typically, that's what we get. But
What do you mean they work with the business? They put personal
everything-
expense
they
and then
separate
business
it.
expense
Yeah, they
together.
separate it. They separate it. Their personal is their personal, and the businesses has everything that the business is bringing in and out. Personal is just, whatever they want to have to pay their mortgage or pay their bills and things like that.
And then
Put it on the
usually
bank
when you do the business and the personal like that, did you guys eventually come and ask for the personal bank account if the person provides you the business account?
I'm gonna ask. I'm gonna get options, right? I'm gonna see how that individual works with their business and see which way is best for them to qualify them to give them the most income.
And who benefit the most from this new non-QM loan?
It's gonna be the actual customer. It's gonna be the consumer, right? Because there's going to be your traditional ways where if the non-QM loans didn't exist, you wouldn't be able to obtain a home.
So is this better for people on LLC or people on S Corp or people that have a huge business?
All of them, from your mom and pop spots
Okay.
to your big incorporations. It just depends on what you're trying to get and what type of loan is best for that situation.
But question, I'm sure there's a catch, because if you're giving me money like that and you just want to look at my business expense or my expense in general and you only care about my revenue, what's the interest rate?
Interest rate is going to be high. So again, if we're not looking at income, these type of loans are more riskier, right?
Yeah.
So we're going to be looking at people that have FICO scores of at least 680 and above.
Okay.
Right. We're going to be looking at interest rates anywhere from 7.5% to 8.2%, depending upon what your FICO score is and how much money you're putting down on the loan. But yeah, it's gonna be higher interest rates.
Is the down payment higher than usual?
The down payment can start at 10%.
Okay.
For your non-QM loans and go all the way up to 20%, depending upon the situation.
Okay. So yeah, I guess that's what you have to do when you're trying to.
Again, at the end of the day, the type of space that we're in right now, with interest rates being where they're at, this is definitely a good option for clients to be able to obtain properties, to be able to acquire and get into the real estate game if you're trying to find a primary home or if you're trying to look for an investment home, or if you're trying to look for multiple investment homes. This is going to be the program for it.
And how long the non-QM exists? I haven't heard. I started hearing about it lately for the last 2-3 years.
It's been out there for a while, but
But nobody used to care?
No, nobody did it because it was a high cost loan. Right?
Oh, maybe because now everybody's in a
We're in a
6-8% anyway.
Yeah, we're in a tight space, so these are becoming more popular. I'm doing these loans more than I've ever done them before in my 20 years.
I think it's because the economy is in a way that people are not necessarily making as much, the W-2 people, and then they start looking at the spouse that we need to qualify. So we need to figure out a way to qualify, right?
Yeah.
Do you see a lot of couples like husband and wife? One is self-employed, the other one has a W-2, but now we have to combine both of them because it's getting difficult to qualify for those mortgage numbers too high.
Exactly. So, I mean, you have situations where one might be self-employed, one might be W-2, both might be self-employed, both might be W-2, right? There might be a situation where they have an LLC on the side, right? We have a thing called a DSCR program. With the DSCR program, basically, we don't look at any income. The actual asset of the program is the actual property itself, right? So as long as the rent of the property is 1% over the mortgage, you automatically qualify, no matter how much income you bring in.
But you still care about the credit score.
We care about credit.
Yeah.
We care about credit and the actual product itself, which is the property. So as long as we're looking at it and seeing that it's a cash flow producing property, that's all we care about, because that's where the risk is going to be at.
In cases like that, it's better to find a property they already rented, right? If somebody is trying to do an investment, it will be better to have it rented so you can do the calculation right away, or it doesn't matter?
It doesn't matter, because the appraiser is going to let us know what that rental analysis in that area is going to be for rent. So we can use that up front without a tenant even being in the property.
Okay, and then one of the non-QM loan is the investor cash flow. So what does one entail exactly?
Yeah, so that's just like what I was talking about. That's the DSCR program,
Okay.
right? So that's going to be for investors, people that are looking to invest. And with these non-QM loans, on a traditional loan, you can only have 10 houses under one person's name, right? Under this non-QM product,
As many as you want.
You can have 100 as long as you can afford them.
So can I ask a question? What
Yes,
is
ma'am.
that DSM?
DSCR?
Yes.
Yes, ma'am.
What is that? What does the acronym stand for?
Debt service coverage ratio. If I may have to look it up, but it's somewhere like
around
that.
the line.
We call it DSCR.
Okay.
That's what we call it. But yeah, so basically with the DSCR, as long as the property, the rent is 1% over the mortgage, 1%, you automatically qualify.
Did you hear that, Alex?
What?
You need to buy a house.
And that's,
Find
that's what
something,
people are doing.
1%
What?
over the
That's what
mortgage.
people are doing.
Give you a bank
Interest rates gonna be high.
statement. Make sure your credit's at
Closing costs is gonna be a
680.
little
You get the
higher.
house.
But you're able to acquire the property with no income.
Oh my gosh.
No income. Yeah.
That's what we call American dream.
Yeah. So the thing with real estate is, guys, you're going to be able to tell with the programs that they're giving where the state of the economy is.
Yeah,
At that time.
that's clearly what's
It-
going on now.
it-
They try to put people in home no matter what,
No matter what.
and
So-
then we'll figure out the interest rate later.
Exactly.
Get in there, make your money,
Exactly.
protect your asset. You make cash, but the value of the money goes down. So,
Exactly.
in order to protect it, to save on taxes, get some benefit out of it, just put it in the brick.
No, for sure. For sure. So, we're always able to see up front and first where the economy's going based off of the programs that they're giving us. Because things that I couldn't do yesterday, I can do today. So.
But this program seems a little bit too good to be true. What are the real risks?
Well, I mean, the only risk that's there is, how much money you're gonna have to put down, right? You're gonna be looking at 20 to 25% when you're looking at the DSCR program. What other risks?
Are
could there be?
the closing costs or the fees with the lender a little bit higher than normal?
Yeah, everything's high. Everything's high. When we were doing one of our clients' loans, they had some kickback on the cost of it, but there was no other way that they would have been able to acquire the property if we didn't go that route. So again, it's going to be for specific type clients. It's not going to be for every client, but if you're trying to acquire the property, non-QM is the way to go.
And what are the misconceptions people have that you would like to address to make sure it's clear about the non-QM?
Misconception is that I'm going to be stuck with this interest rate for the next 2 to 3 years. Keep in mind, guys, we haven't been in a refi market yet
In a long time.
in a long time. So the refi market is coming. So all these non-QM loans, it's all a process, guys, that they're doing. So when they come up with these non-QM loans, you're going to have people on higher interest rates, right? And then a year to two later, you're going to have your refi boom, where you're just going to be refining people out of these high interest rates into lower interest rates. So it's just all a process that everything piggybacks off of each other. And it's just the system.
I should be a loan officer. You're always making money. Like when he's not giving a loan, you refinance.
Well, it's not all the time. It's not as sweet as it sounds, but yes, we do always have a product available for our clients.
Just in the nick of time.
Exactly.
You're the best one. We need to have you always give money.
No, for sure, as long as you qualify for it. Just remember that you have to qualify for the program. I'm just a messenger.
Okay. So now let's switch here and talk about the seller financing. So instead of getting a loan from a lender, this time the seller who owned the property decide to finance you the house that he's selling to you. So as he's not giving you any money, you guys just worked out interest rate, a monthly payment, and a down payment, and all of that in one. and then you go to the title company, and the title company would transfer the title and the ownership to you, just like you would do with a regular lender. But the difference is the seller is the one who do the qualification.
Yeah.
And that's pretty. I did a lot of them with investor. So that's fairly easy. You do all the calculation. One of the things people need to really pay attention when you do seller financing is be sure that if you're not good with money, you can, if you, the seller, make sure the person escrow every month for the taxes and insurance on the property, because still act like you're a lender. The lender always require us to have insurance and escrow because they don't want the asset to be lost for taxes, right? Because no matter what happened, the taxes people, the government has priority over the lender. The taxes haven't been paid, right? So if you owner, you own the property and you want to sell or finance it to somebody, be sure when you do the transfer, the person escrow or know that they're really capable and able to escrow that, because you don't want the person to accumulate 1 year, 2 years of taxes and they're behind, and then they lose the property because of that.
So on the seller side, they're pulling credit.
You can. So if the seller has a good realtor, aka moi, so then I advise my client to pull credit, to look at bank statement, to verify that the person really have the savings or the money for the down payment as it's supposed to. You do the transaction as you would normally do with a regular buyer. You do your home inspection and things like that, but on the financial part. And then also you help the seller with drafting the monthly payment. We have plenty of tools that Houston Association of Realtor provide to us. And then with the seller, is it drafted? What will be the monthly payment? If the seller wants to give the person maybe 20 years, you can do in 20 years. Some people, sometimes they say, hey, you know what? We'll do seller financing for 5 years. Give me 20 to 25%. So know that most of the time when you do seller financing and you're the buyer, you will pay about 10 to 25% above the list price, because it's a risk for the seller, right?
Yeah.
So they're going to charge you a little bit more money for that, and they will ask you maybe 20 to 30% down. I rarely see 10. Most people do 20 to 30% down.
What's the amortization schedule on the seller finance?
It's kind of randomly done based on what the seller wants. Like every month, this is the amount that I want to have every month. So if the buyer can afford it, that's how they do it. And then you put the number of years. So if you say, I want a 20, if the buyer say, I can only afford 2,500 all in taxes, insurance, monthly payment. So you work with that number and you go back with the seller to see if the seller is satisfied with what he's going to get after the taxes and insurance, right? So let's say after tax and insurance, it's because you put an interest rate, right? Sometimes they put 9, 10%, 8 to 10% interest rate. That's what I did over the years. So it's 8 to 10% interest rate. And then you do your calculation based on what the buyer say they can really afford. So the seller would say, well, I like this number, or I don't like this number, or I need a little more. And then you submit all the paperwork to the title company. Their lawyer will draft the paperwork, the forms and the loan amortization and all of that based on all the information you provide. So as a realtor, I provide this is the monthly payment, this is the interest rate, this is how long, and this is the term. So I give that to the title company, and their lawyer will draft all of that, and then the buyer and seller will sign that at closing.
So they can refinance out of that.
Yeah. So what I oftentimes advise some of my client where that sometimes they don't want to stay 20 years. They don't know where they will be. Sometimes they want to pull their cash, right? So you do, okay, we're going to do an amortization on 25 years, for example, but I'm giving you 5 years to refi to your own name.
So you won't have a prepayment penalty.
Sometimes you can. Sometimes you say, I want you to stock with me for at least 5 years. And then after that, you can refi. Or sometimes the seller is like, well, I'm giving you 3 years to refi to your name because I don't want to deal with this no more after 3 years. Because sometimes you're self-employed, you can't qualify. Maybe the non-QM doesn't work for you.
Yeah.
You know? Still, it doesn't work because you can't qualify for whatever reason, but you still have a gig that's making you money and you're sure about yourself. You just need a place like anybody else. Then you can work it out with a seller. It's better to do it if you do own the place outright, like it's your property, there's no more free and clear. But sometimes you can still do it when you have a loan on it. Okay. And that's what we call a wrap. So let's say you have a 3% interest rate like we had a few years ago. you can turn around and charge this person 8%. So you capture the middle of it. You still force them to escrow, and then but be careful with that, because if your lender does not give you the right to transfer ownership to somebody else, they can ask you to pay off the loan right when they find out about it, right? So be careful with that. This is a risk for the seller, because the lender can ask you, "Oh, you change ownership of it. Now the loan is due. You need to pay it off now." A lot of investors do it. They do the wrap. Let's say you own a house and you can't pay for some reason. They come in and they pay the $30,000-$40,000 you own to your lender, and you do a wrap with them. They will pay you every month, and the investor will be responsible to pay your mortgage for you. That's another way for anybody that want to purchase a property but they just don't want to go into a loan or put too much money down, but they want that property and put it for rent. And then it just help the person who have financial difficulties, for example. A lot of investors do it like that. Yeah. But if you just a simple person and you just want to do it, you can definitely do it. If you're someone who wants to buy and seller financing is an option, maybe you don't have, I don't know, I'm just talking paper. Yeah. You don't have paper in America, and then you want to buy a house and this is your only way, for example. That's a good way. I've done it and I've seen it with people in the past.
Never had experience with seller's finance.
Yeah, so the advantage can be for both parties. You get a home, you don't have to go through a lender, and then you as a seller that you keep making money on your investment. Yeah. Every month you can put stipulation in there, and then you move on.
Yeah, for sure.
So now the next non-conventional is hard money lender. That's your forte.
Yeah, well, we don't do hard money loans, but we do have relationships with hard money lenders. So basically, on our side, what I typically do with hard money loans, that's going to be for people that are looking to rehab their properties, right? So you got a distressed property, you want to go in there and fix it up. You don't want to use your cash, or you might not have the cash. You go find a hard money lender that will come. If you're a first-time investor, they're going to come look at the property, look at the numbers, make sure they make sense. For your more experienced investors, once the hard money lender sees that you've been doing multiple properties and you got the hang of it, they'll just sign off on it. Yeah.
What's the difference between the hard money lender loan versus the non-QM?
Yeah, so hard money lender is kind of similar to the seller financing part, right, where you got the hard money lender that's coming up with their own terms, right? It's their money that they're lending, so you're going to have higher interest rates, right? You're going to have higher fees as far as what you have to pay the hard money lender during closing. And typically, one of the things that the hard money lender do when they're assessing the properties, the investor just wants to be in that hard money loan for at least 2 months. Because after 2 months, the rate keeps going up and up the longer that you're in that hard money loan. So, you got some people that may not be able to finish the actual fixing up of the property, and the hard money lender is able to acquire the property and keep it for themselves.
Yeah, so the hard money lender is mainly for if you trying to have an investment property, not for you to buy and leave. The non-QM, you can use it for you to buy and leave and stay in there. Yeah. But the hard money lender is mainly for investor. They can give you between 6 months to a year. It's a balloon payment. I use it a lot when we flip.
Flipping home.
Yeah, when we're flipping. But sometimes you'll see a beautiful property that cannot qualify for a conventional loan or another type of loan because it has too much damage to it and is not livable. You can get a hard money loan, get the property. They will give you the money to purchase, and they give you the money to fix if you ask for it, as long the number makes sense, right?
It makes sense, and both of y'all are going to be owners of the home. So typically what happens with us is I'm trying to create an exit strategy for the investor, right? So we'll pre-qualify you on the conventional side to make sure that you qualify. And then once you pre-qualify with us, you automatically pre-qualify with the hard money lender. In our case, it's Red Door that we use and have a relationship with. So once you start that process with the hard money lender, by 6 weeks being in your rehab, we're already starting your permanent financing loan going so we can hurry up and get you out of that loan. Because like I stated, after the 2-month time comes.
Yeah, so you can refinancing.
So we pay the hard money lender what's owed to them at the time of when it's time to close. You already have your equity based off of the hard money, the repairs that they were able to do. Now, whatever your ARV, which is after repair value, whatever that value comes in at, we're able to refinance. The only thing that's going to come out of your pocket would be the appraisal fee because it's done like a refinance, not like a purchase because you already own it with the hard money lender.
Yeah, so once again, so pay attention to hard money lender is good when you need cash for a flip or you need the cash to help you fix the property and then turn around. You can refinance with a conventional loan or you can turn around and resell the property. But it's not made for you to live inside the property because it will make you sign a document like, this is for investment.
Yeah, it's only for investment. You can't do it on your primary. They have other unique products for that. You can definitely give me a call to get those options as well.
Is it true, this is a myth that some people can hear, is it true that alternative financing is good for people with poor credit? Is that true?
No, it's not true because people with poor credit aren't going to even be able to qualify. Yeah, so these type of loans are going to be for people that have assets and that, like I stated, you're in that credit score range of at least 680 or above because that's where your credit score is going to help you out the best. The higher credit score you got, the lower that interest rate is going to be from like 7.25%, going up. So you're going to want to pride yourself on having strong credit and a lot of assets. So if I see that, you're not in that situation, I'm not going to advise you to go that route.
Do you think those non-conventional type of loan would take space completely for all regular conventional FHA or not?
Nah, Fannie and Freddie ain't going to allow that to happen. They want their money. Nah, this is just a little rainy a time span that we're going through where, these loans are very popular, but as time goes on, they're going to start fading away.
And which advice would you give someone who's considering doing it for the first time?
Look, at the end of the day, just close your eyes. Just close your eyes. You're going to see the numbers. You just have to make sure that you have a great team. What I would advise people to do, make sure you have a great team from if you're doing a hard money loan, from contractors to your realtor to your insurance people to your lender, especially your lender. You just want to make sure you have a good team to where they explain the process to you because with these investments, it's all a number game. You can go and do the process and you can tell your friends, hey, I've acquired a property, I've done this, I've done that, and it sounds good, but if the numbers aren't right, it's not going to make sense.
Yeah.
Right? So you want to make sure that you're creating a cash flow property where you're in the green and you're seeing a positive flow moving forward. So I would just advise people just do your research, study the product that you're trying to do, and have a good team around you.
Yeah, I have several times. But this particular story kind of hurt my feelings for him because this is someone who called me, was referred to me, and he said, hey, I purchased a property, so it's a new community, and they say all the things will be good about this community. It is true. Buying a property in an up-and-coming area could turn out to be really great because you're one of the first one. You're purchasing the property at a lower number because 3-5 years, if the development keep going in the right way, and you see that maybe HEB will come around or other big store are coming around and they're buying all of this land, that could be a good thing for you. And they're building the county decide to build schools in a community or around it, more schools, or something is about to happen, which this is what he saw that community, he jumped into it. The problem is he got a conventional loan. The monthly payment on it was $23.50 a month. But he decided to rent the property for $2,500 a month. Okay. But the neighborhood rental market cannot bear more than $2,300 a month. Wow. So he didn't do the proper work before entering under contract. So now he placed his property on the market. The house is sitting for over 90 days, and he has his personal mortgage and this mortgage to care for.
Yeah.
He can do it 1 month, he can do it 2 months, but 3, 4, 5, 6 months, he's like, I
start
can't
taking
afford
a
this. I
toll.
need to put it in there. And then he had to drop his price from $2,500 to $2,300, which he left him with $50 negative that he has to come up out of pocket. The problem when you're trying to be an investor like that, the minute you have one phone call for there's a problem in the house, all your profit is gone, or even more. So, and then every single time because it's a new community, new construction, the taxes will go up because there's more home, the prices are going up. So it's going to be completely upside down in there. So whatever you decide to buy an investment property, the work is done, as we say in French, en amont, meaning before.
Yeah.
Okay? Do the homework before, run the comp, check out everything before you submit an offer. Contact your lender and say, this is the property, this is the price, how much will be the mortgage payment on it.
Yes.
It's very, very important for you to do the proper work before you get himself. And I met a lot of people like that. Unfortunately, they didn't do it.
Yeah. No, numbers matter. It's all about the cash flow. So you don't want to be in a situation where you're in the red and you got money coming out of your pocket even more. I would advise that.
Especially in this economy.
Oh, yeah. It's tough. It's tough. So, yeah, man.
All right.
Good team.
All right, guys. Hopefully you learned a lot. Did you learn a little bit?
I learned a lot. I was like, wow.
Are you ready to buy?
No. Not in this market.
That's okay. I'll be your realtor when you'll be ready.
Yeah,
but anyway. All right, guys. Hopefully you learned a lot. If you have any question, concern, please feel free to let us know. DM us directly. Make sure to comment, subscribe, and follow us on all our social media. We are here to help you. Thank you for joining us again, and we'll see you later. Bye-bye. À bientôt. Came here in 2007, right in the middle of the crazy crisis. If your heart is not into it, do not do it. That's what I always tell them.
If you're making around 70K, look to be able to qualify for a home somewhere around 250, 275 in that bracket.
Onions and juices and all that, and put some lemon and onion and you make him drink it, right?